Okay, so you've got $100. It's a start, right? But the real question is, how do you actually make it grow? Well, in this explainer, we're going to break down the exact steps you can take. Think of it like climbing a ladder, starting from the super safe options and going all the way up to the super bold.
I mean, this is the dream, isn't it? Turning a pretty small amount of money into something that could actually make a difference. It might sound like a long shot, but honestly, it all comes down to understanding the path. And that's exactly what we're going to map out for you, step by step.
All right, so here's the game plan. We're going to climb what we're calling the investing ladder. We'll start on the ground floor, where it's all about safety first. Then, we'll move up to the middle section, which is the real growth engine. After that, we'll take a peek at the high-risk top floor. And finally, we'll wrap up with a really important warning and a key question just for you. So let's just dive right into the big question. If you had just $100, and that's it, where should you put it? We're going to treat this whole thing like a little experiment, you know? Let's explore what actually happens when you put that $100 into a bunch of different investment types.
And this right here, this is the central idea for our whole journey today. The risk ladder. It's a really simple concept, but it's so powerful. The more risk you're willing to take on, the higher your potential reward could be. Let's dig into what that actually looks like in the real world.
All right, let's start our climb on the very first rung of the ladder. This level is all about building a solid, unshakable foundation. The goal here isn't to get rich overnight, not even close. It's to make sure you don't go broke when life throws you a curveball.
So our first two options are kind of the bedrock of personal finance, a simple savings account and the classic safe haven gold. Now, they're used for very different things, but they both have one thing in common. They prioritize security above everything else.
A high-interest savings account? We're giving that a risk score of just 1 out of 10. Why so low? Well, because its main job isn't to make you a millionaire. Its job is just to be there when you desperately need it. You really got to think of this as your emergency fund. You know, when your hot water heater decides to give up in the middle of winter, having this cash on hand is what saves you from racking up high-interest credit card debt. It's your financial safety net, pure and simple.
Next up, we've got gold, with a slightly higher risk level of 2 out of 10. Now, the reason people run to gold is pretty fascinating. Get this, since 1913, the US dollar has lost about 95% of its buying power, all because of inflation. Gold is seen as a way to protect that value because, well, unlike paper money, you can't just print more of it.
Okay, our foundation is solid. Now it's time to actually start climbing. Let's move up the ladder to the next section, what we're calling the growth engine. This is where we make the big shift from just protecting our money to actively trying to grow it. First up is something called an index fund. And honestly, the best way to think about it is like a bag of Haribo gummies. Yeah, you heard me right. Instead of trying to pick out the single best flavor, an index fund just buys you the whole bag with all the most popular ones already in it. For example, an S&P 500 index fund automatically spreads your money across the 500 biggest companies in the US. Think Apple, Microsoft, Amazon. This diversification is huge because it massively reduces your risk compared to just betting it all on one company.
And look, this isn't just some theory. The legendary investor Warren Buffett famously made a $1 million bet. He bet that a simple, boring S&P 500 index fund would beat a portfolio hand-picked by expert hedge fund managers over 10 years. And guess what? After a decade, Buffett won the bet. Hands down. It just goes to show you that for most of us, keeping it simple and steady is what wins the race. Our other medium risk option is a REIT, which is short for Real Estate Investment Trust. It's actually a pretty clever way to invest in real estate without needing, a giant down payment to buy an actual house. Think of it like you and a few thousand of your closest friends all pooling your money to buy a shopping mall or an apartment building. Then you all get to share in the income from the rent that all the tenants pay. Okay, let's actually put these two side by side, shall we? You can see they both have the same pretty low risk score of 3 out of 10. The S&P 500 index fund gives you a piece of the whole market and is all about long-term growth. A REIT, on the other hand, is laser-focused on real estate and is really designed to kick off passive income from rent. Both are just really powerful tools for building wealth over the long haul.
All right, deep breath. We're about to keep climbing. We're heading to the top of the ladder now. And let me tell you, the air gets a bit thinner up here. The rungs are a little shakier, and the potential for a fall is way higher. But so is the potential view from the top.
And up here, we have to make a really critical distinction. We're shifting away from investing, which is about buying into the long-term value of something, and we're moving into the world of speculation. This is more like a bet on short-term price movements. The rules of the game are just completely different at this altitude.
So, our two high-risk options are picking individual stocks and, of course, diving into cryptocurrency. And I mean, just look at the jump in those risk scores. We've gone from a stable 3 out of 10 all the way up to a 6.5 for single stocks, and then a wild 9 out of 10 for crypto. This is a whole different ballgame, people. And if you want to really feel that risk, just look at this. Let's say you'd put $100 into Bitcoin at its peak back in late 2017. Just 1 year later, that $100 would have been worth only $17. That's an 83% loss. The potential for massive gains is what gets all the headlines, but you have to remember that the potential for huge, devastating losses is just as real.
So there you have it, the whole ladder, all in one place. We've gone from the absolute safety of a savings account to the long-term wealth building of index funds, all the way up to the speculative world of crypto, which, let's be real, should only be for money you are truly 100% prepared to lose. Think of this as your personal cheat sheet for matching your own financial goals with the right level of risk.
Now, before we finish up, we have to talk about one more thing. But I've got to be clear, this one is not on the ladder. In fact, it's not even investing. It's a cautionary tale.
Let's talk about playing the lottery for a second. Your odds of winning the big jackpot are roughly 1 in 14 million. I mean, just to put that in perspective, you are literally thousands of times more likely to win an Academy Award. It's just not going to happen.
But here's the real gut punch. In the experiment from our source material, they took $100 and spent it on scratch-off tickets. And how much did they get back? Just $50. That's not a return on your investment. That's a negative 50% return. You just lit half your money on fire. And this right here is probably the most important takeaway from this whole thing. Over the long term, investments like the stock market or real estate are designed to grow in value. They have a positive expected return. Gambling, on the other hand, is set up by design for the house to always win. It has a mathematically negative expected return. They are fundamentally completely different things. So, we've climbed the ladder, we've seen the safe foundation, we've seen the engines for growth, the high-stakes world of speculation, and of course the guaranteed losses of gambling. The knowledge is now yours, so the only real question left is,
What's your first step going to be? Are you going to start by building that crucial safety net with an emergency fund? Or maybe you're ready to start your growth engine with a nice, diversified index fund. The choice is all yours. The first step is always the hardest, and it's always the most important one. But now, you have a map to help you take it.